Hey everyone, and welcome back to the channel. Today we demystifying a term you've probably seen a million times but maybe never fully understood. APR, it's on every credit card offer, every statement. But what does it actually mean for your wallet? Stick around because by the end of this video, you'll be an APR expert. So, what is APR? APR stands for annual percentage rate. In the simplest terms, it's the price you pay for borrowing money. Think of it as the interest rate for an entire year, rather than just a monthly fee. When you use your credit card and don't pay the bill in full by the due date, the credit card company charges you interest on the remaining balance. That interest is calculated using your APR. Now, you might be thinking, but I see different kinds of APRs listed, and you're right. It can get a little tricky, so let's break down the most common types. First up is the purchase APR. This is the big one. It's the rate that applies to the things you buy with your card. If you go shopping, buy groceries, the purchase APR is what you'll be charged on that leftover amount. This is the rate you should pay the most attention to for your everyday spending. Next, we have the balance transfer APR. Many credit cards offer you the chance to move debt from a high-interest card to their card, usually for a lower interest rate. The rate they give you for this transfer is the balance transfer APR. Often, you'll see amazing introductory offers like 0% APR for 12 or 18 months. This can be a fantastic tool to pay down debt. There's usually a balance transfer fee. And once that introductory period ends, the APR will jump up to a much higher standard rate. Then there's the cash advance APR. This is the rate you're charged when you use your credit card to get cash, say from an ATM. I have to be honest with you guys, the cash advance APR is almost always significantly higher than your purchase APR. Plus, like purchases, there's usually no grace period. Interest starts racking up the moment you get the cash. On top of that, there's a cash advance fee. It's a very expensive way to borrow money. Finally, you might see a penalty APR. This is the highest rate of all, and it's what the credit card company can charge you if you break the rules. For example, if you miss a payment or make a late payment, your issuer might switch you to a much higher penalty APR on your existing balance and future purchases. It's their way of saying, hey, you're a riskier borrower now. The good news is, under the Card Act, if you make 6 consecutive on-time payments, they generally have to revert you back to your standard APR, but it's a situation you really want to avoid. So how is this APR actually calculated and applied to your account? It seems complicated, but the concept is straightforward. Your APR is an annual rate, but your credit card company charges you interest daily or monthly. To do this, they calculate what's called a periodic rate. For a daily rate, they simply take your APR and divide it by 365, or sometimes 360. This gives them the daily periodic rate. Then, they take your average daily balance for the billing cycle and multiply it by this daily rate. They do this for every day in the billing cycle and add it all up. That total is the interest charge you see on your statement. This is why even a small balance can grow if you're only making minimum payments, because you're being charged interest on your balance every single day. A key concept to understand here is the grace period. The grace period is the time between the end of a billing cycle and your payment due date. During this time, you can pay your bill in full and avoid paying any interest on new purchases. Typically, this period is about 21 to 25 days. If you pay your entire statement balance by the due date, you pay 0 interest. That's the magic of using credit cards responsibly. You get the rewards, the convenience, and the security without paying a dime in interest. However, if you carry even a small balance over, you generally lose the grace period on new purchases, and they'll start accruing interest immediately. Now, let's talk about what determines your specific APR. Why does your friend have a 15% APR while yours is 22%? The biggest factor is your credit score. A higher credit score signals to lenders that you're a responsible borrower who pays their bills on time. To them, you're low risk. So, they reward you with a lower APR. A lower credit score suggests a higher risk, so lenders charge a higher APR to compensate for that risk. Another factor is the type of card. Rewards cards, those that give you cash back, points, or miles, often come with higher APRs than basic no-frills cards. The bank has to pay for those rewards somehow, and one way they do that is by charging higher interest to customers who carry a balance. Also, APRs aren't always fixed. This means the rate is tied to a benchmark index rate, most commonly the US prime rate. When the prime rate goes up, as set by the big banks, your APR will go up too. When it goes down, your APR should follow. This is why you might see your APR change slightly over time, even if you haven't done anything wrong. It's all spelled out in that fine print of your cardholder agreement. So, how can you use all this knowledge to your advantage? First and foremost, the best APR is the one you never have to worry about. Try to pay your credit card balance in full every single month. If you do that, the APR could be 10% or 50%, and it wouldn't matter because you'd never pay any interest. This is the golden rule of credit cards. But we all know life happens. If you do need to carry a balance, shop around for a card with the lowest possible purchase. Even a few percentage points can save you hundreds or even thousands of dollars in interest over time. If you already have debt on a high-interest card, look for one of those 0% APR balance transfer offers. It can give you some breathing room to pay down the principal without interest piling up. Just be sure to have a plan to pay it off before the introductory period ends. And always read the fine print. Before you sign up for any card, understand all the different APRs, the fees, and the terms. Knowledge is power, and in the world of credit, it's also money. Let's recap what we've learned. APR is the annual cost of borrowing money. There are different types: purchase, balance transfer, cash advance, and penalty APRs. Your rate is mostly determined by your credit score. Most APRs are variable and can change with the market. And the absolute best way to handle a PR is to avoid it completely by paying your balance in full each month. I hope this breakdown made the concept of a PR much clearer for you. It's a fundamental piece of personal finance, and understanding it is a huge step toward managing your money more effectively. If you found this video helpful, please give it a thumbs up. It really helps the channel. And if you have any questions or want to share your own experiences with APR, drop a comment down below. I love hearing from you guys. Don't forget to subscribe for more videos on how to make your money work for you. Thanks for watching, and I'll see you in the next one.